by the very act of diversifying, you're eliminating the potential of being overexposed to the worst performing asset class, but you're also limiting your ability to be exposed to the best performing asset class. The challenge, though, is we can't know without the benefit of hindsight what the best performing asset class is going to be over the next 1 year, 3 year, 5 years, 10 years. I think as human beings, we have very short memories, and we had an incredible decade for U.S. large cap stocks. And in hindsight, yes, of course, it would have made more sense to own more of them. It would 100% in hindsight would have been probably the right move, but we have no way of knowing that without the benefit of hindsight. And so I think you just need to remind people that that's not always been the case. We only have to look a decade prior to the 2000s, where you had a negative 10-year period for the S&P 500.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
For me, the best part of my podcasting journey has been the opportunity to speak to a huge range of extraordinary investors from all around the world. In this series, I have invited one of them, namely Alan Dunne, to host a series of in-depth conversations on the topic of what it takes to be a world-class allocator. In today's world, portfolio construction is fast moving to the top of the agenda of many investors as they try to analyze and understand the riskiness of their portfolios. And with ever-increasing uncertainty around the globe, being well diversified across many different strategies and themes in your portfolio can mean the difference between ruin and survival when the next crisis emerge. The aim of these conversations is to try and understand the experiences that have influenced these highly specialized allocators and the processes they follow to harness the best returns for their clients so that we can all become better informed investors. And with that, please welcome Alan Dunne.
Thanks very much for the introduction, Niels. Today I'm joined by Phil Huber. Phil is Chief Investment Officer of Savant Wealth Management, a $14 billion fee-only registered investment advisor based in Illinois. Phil is also a prolific writer and blogger and author of the recently released book, The Allocator's Edge. The Allocator's Edge is a really comprehensive deep dive into the world of alternative investments, and I think it's a really valuable tool for advisors and allocators. So what better person to kick off our Allocator series than having the author of The Allocator's Edge, Phil Huber. Phil, welcome to the podcast. How is all on your side today?
Very good, Alan. Thank you for having me.
Great. It's great to have you on such an interesting period in markets. It's been certainly an eventful start to the year. How has it been on your side in terms of portfolio management and client interaction?
We're still pretty early in the year, and it's coming off of a pretty strong year. So I don't think anyone's getting too worked up quite yet about some of the January volatility that we've seen. But there's never a dull moment. I think the last few years have demonstrated that.
Absolutely, and I think we'll be coming back certainly to the outlook for traditional assets and alternatives as we go through. But maybe to kick off, Phil, and to set the scene a little bit, obviously you're Chief Investment Officer of Savant Wealth, but to give us a sense of your journey in the world of investing, how did you get started? What brought you into the business? And what brought you to your current position?
Sure. So I kind of grew up in and around the RIA industry. My father was and is a financial advisor. He started his own practice back in the late 1980s and grew that to a good size. And I joined the firm shortly after college in 2008. And so kind of came up through the ranks there. We were a much smaller organization, but I spent, I think, about 12 to 13 years as part of what was called at the time Huber Financial Advisors. And in about, I think, 2015, took on the role of chief investment officer there. I realized fairly early on in my career that, we were very much a financial planning focused organization, like many RAs are. But as we were growing, we saw a need for investment focused leadership in what we were doing, and that was the area that I had the most passion for and interest in, and wanted to focus my time and energy on. So ultimately, that came to fruition, and as we got to 2019 and started to think about our longer term succession planning and next leg of our growth in our journey, we thought it made more sense to partner with a like-minded firm in Savant as opposed to trying to do it on our own. And so ultimately we came to a deal to merge with Savant, and that closed in February of 2020. So just just in the nick of time before things got really chaotic in the world from COVID coming on. And so I just essentially took on the same role I was responsible for at Huber Financial as chief investment officer for Savant. I would say, very similar responsibilities, just a larger enterprise and a larger footprint, and a deeper bench and team that I have supporting me. So that's been really a positive experience so far, and we're coming up on our 2-year anniversary here in a few weeks. And it's been great. Savant's a fantastic firm, and we have a lot of great capabilities, not just on the investment side, but also in financial planning and tax planning, estate planning, and all the other areas that touch people's financial lives.
Good stuff. And I touched on the book you've just released not so long ago. Obviously, you have been quite active in terms of writing your own blog and posting on social media. What was it that really prompted you to take the step to go and write a full book on allocations and allocating to alternatives in particular?
Yeah, I would say the activity of writing and blogging frequently online is ultimately what kind of led me to who became my publisher. So we started engaging in conversations several years ago, and really it was they're kind of gauging my interest in writing a book. And aside from being very flattered that they were interested in working with me, it was certainly a bucket list type item that I had always wanted to accomplish at some point. So it really became a function of the opportunity was there. What topic really excites me to write about and devote a good chunk of the next year or two to really work on and dive deep into. And it became apparent pretty quickly that topic would be alternative investments, just because we have, I would say, substantial allocations to alternatives, but it's not like all we do is alternative investing in our clients. Our portfolios have pretty strong representation from traditional asset classes as well. But what I kind of realized in practice in a lot of the conversations I was having with the advisors on our team and the clients that they serve is, despite call it the average alternatives allocation being 15 to 20% of the portfolio, it was really where most of the investment related conversations were happening between advisors and clients, and probably not by surprise. And I attribute that to a couple of reasons. One is we were kind of in the midst of a pretty lengthy bull market in stocks, and so anything that's sort of underperforming stocks or acting as a bit of a performance drag at the time, gets a bit of scrutiny, associated with it. And I think too, just it's a very, the word alternatives doesn't really tell you much about what something is, but more about what something isn't. And it encompasses a wide array of different asset classes and strategies that sort of fall outside the traditional umbrella, but that could be anything from real estate to private equity to managed futures to insurance linked securities and many more different subsets within that broad classification. So because there's such a degree of heterogeneous assets, it can become a little bit daunting, I think, not just for clients but for advisors as well, to try to decipher and set expectations appropriately for the things that go into that bucket. But it's also things that people are not necessarily accustomed to owning. So it's new things in the portfolio, and so they just want to better understand, like, hey, what is this fund or what is this asset class? Why do I own it? What's the role in the portfolio? Where is it being sourced from? And so I think I saw a large sort of education gap that still needs to be filled, both at the professional advisor level and at the end client level, to get everybody just sort of more conversant and more comfortable with what we think is going to be a more important part of the portfolio as we look ahead to the next decade.
Great. I think that makes a lot of sense. I mean, from my own experience in the managed future space, big part of our role was always education as much as portfolio management, and it's certainly something that I think will resonate with a lot of people and be a really valuable resource for a lot of advisors and allocators going forward. You touched on it, your role in Savant. It's not just alternatives. Obviously, you're overseeing multi-asset portfolios. If you could just set the scene a little bit there in terms of the typical clients, the types of portfolios that you're constructing and advising on.
Sure. Yeah. I mean, so ultimately, we're in the business of creating multi-asset, diversified portfolios that are designed to be in service of the client's ultimate financial goals and objectives. And it's our job to, essentially employ what we, feel is an evidence-based approach that, we're designing portfolios to tilt the odds in favor for our clients of long-term success and positive investment outcomes as best as we possibly can. And I think what's interesting in the way that we work with thousands of different clients of all shapes and sizes. And what's interesting about working with individuals, as opposed to institutions, is it's not just one large pool of capital. It's, many different pools of capital, and each of those pools of capital can have, a handful of different account types. When you're looking at a typical household, you often see, a trust account or multiple trust accounts, and traditional IRAs and Roth IRAs and all sorts of different, tax ramifications and things like that. So we have portfolios that are designed to meet, all different sorts of objectives, ranging from very conservative capital preservation focused, goals, to long-term capital appreciation focused portfolios. And then even within those different sort of risk spectrums, we have a few different flavors based on the client's ultimate sort of preferences around things like, liquidity and certain types of fund structures that are allowed or not allowed, and how tax efficient we need to be focused on depending on the mix of, dollars they have spread across taxable versus tax deferred accounts. And so, by and large, we focus more so on what I would say are more liquid types of vehicles. Just given the kind of typical client we work with, there's not, you know, I, sh- I don't want to paint with too broad a brush, but typically speaking, there's not a huge appetite for, long-term illiquid investments. It's more like, retirement portfolios where we want to have the ability to meet any sort of income needs that the client has, or liquidity, potential liquidity needs that are there. And we also want to retain the ability to engage in ongoing rebalancing of the portfolio, tax loss harvesting, and other things that sort of require a little bit more of a liquid approach. So we have a handful of strategies that are in some of our model portfolios that are a little bit less liquid, but by and large, it's mostly daily liquid things like ETFs or mutual funds.
Okay, great. I guess that's a good segue into the kind of the first topic that you touch on in the book, and that's the kind of the 60/40 portfolio. And I think your first chapter is hindsight is 60/40. And I suppose the 60/40 portfolio is kind of the benchmark for a lot of those typical liquid multi-asset portfolios. And you touch on what the challenge is with the 60/40 portfolio, namely that obviously we've got expensive valuations for both stocks and bonds at the moment. So on a forward-looking basis, things look more challenging. Why do you think the 60/40 portfolio became such a benchmark in the industry in the first place?
Yeah, I mean, it's hard to pinpoint exactly what made it sort of the de facto blended portfolio, but I think just the evolution of how financial products have come to market and allocators have focused. Most people, like you have very aggressive clients, you have very conservative clients, but generally, I mean, I think most people kind of on average tend to fall somewhere in the middle where they want some participation and upside, and they sort of need it to meet their long-term return objectives. So that's where the stock allocation comes into play. But then there's also a need for defense to sort of mitigate risk and manage volatility of the overall portfolio so that clients can stick with it. And then particularly when you get to a later part of the investor life cycle, and you're more focused on sequence of return risk, and there's a need for liquidity and income. Bonds have historically played that role, and so I think it's a very intuitive portfolio. A little bit of an edge to the stock side, and giving it 60 as opposed to like 50/50, and that you want to have that long-term upside appreciation that stocks have typically offered. But I think it's a mix that has an intuitive nature to it. I think people kind of get what stocks and bonds are, even your most novice investors understand sort of the role of those two asset classes. And so there's an intuitiveness, there's a historical, return and risk benefit in the sense if you just look back the last 40 years, it's been a really good portfolio to own. It's delivered, meaningful returns and decent, risk adjusted returns. And so it's kind of delivered on its premise. And it's also gotten very, very easy to implement. As time's gone on and we've seen the emergence of passive investing and the explosion of ETFs, like this is a very cheap and easy portfolio to build today. With a few clicks of a mouse, you can buy one or two funds and have global exposure to public stock and bond markets. And so I think there's appeal there too, and from a cost and ease of use standpoint. So very, very easy to understand why so many investors and their advisors have sort of anchored to this type of asset allocation because it served them well. So it's kind of like, why would I fix something that doesn't seem to be broken? But if we look ahead, not to say that, I think there's too much written about sort of the quote unquote like death of 60/40. I think that's a bit too extreme in the sense that it sort of implies that there's a near term, catastrophic event on the horizon. To me, the future for 60/40 is more just this kind of disappointment that will likely happen relative to people's expectations, and more of sort of a slow pain as opposed to a fast pain, in the sense that you're not going to notice it necessarily immediately. If we look at the stock side, you mentioned elevated valuations, particularly in the U.S., but that's been the case for many years now. And so, as we know, valuation is a very blunt timing tool, and stocks can get more expensive, and it doesn't really tell you much about the next year or 2 years. But generally speaking, high valuations, are tend to forbear lower expected returns than average, and vice versa. And so, we kind of recognize that over the next 10 years, it seems unlikely we're going to repeat the experience of, U.S. large cap stocks of the prior 10 years. But the path to get there, will be very volatile and sort of uncertain, and anything can really happen in the short term. Now, I think the picture in bonds is a little bit more crystal clear in the sense that there's a high degree of predictability with your starting yield and what your kind of forward 10-year total return is going to look like. It's going to be generally in that same ballpark, plus or minus 50 basis points, something like that. So if you got a starting yield of 2, it's very likely your total return over the next 10 years is going to be somewhere close to 2%. And so that's sort of the math of bonds is a little bit more clean cut than it is for stocks. And so that's probably the part that worries us the most, is investors being too reliant on the role of bonds, because the interest rate outlook and the fixed income environment is much different today than it was 30 years ago, and we don't have the benefit of a secular decline in rates over the next 30 years to act as a tailwind for that part of the portfolio. So it's not to say that get rid of the 40 altogether. It's just to say bonds can still serve a role. They're still going to likely be sort of a defensive part of the portfolio in times of recession or deflationary environments, for clients that really place a premium on having liquidity in the portfolio and a source of stability. High quality fixed incomes can still have a place, but we just think it needs to be sort of de-emphasized a little bit, and we need to open up the door to other types of diversifiers, knowing that the alternative to 60/40, having a low expected return outlook, is not necessarily okay, we'll just ramp up your stock risk and go from 60/40 to 80/20 or 100/0. That's not the right answer for most people either, because that entails a higher degree of volatility that many people might not be able to stomach. And so I think, when you pair that outlook with the fact that more and more alternatives have come to market and are now more accessible to your average investor and your financial advisory type allocator, I think it just gives us a broader toolkit and a higher degree of raw materials that we have to build portfolios with. And so it's not as, we're not as limited as we might have been 20 years ago. There's other, asset classes and strategies we can access that we think improve diversification and improve the risk-adjusted return outlook for multi-asset portfolios.
And obviously, as I said, we're speaking on the 26th of January today, so it's already been a pretty tough month for both stocks and equities. I think back of the envelope calculation, the 60/40 portfolios will be down 5 or 6% month to date. And what we're seeing in the markets this month is a concern about, well, inflation has been a concern for a few months now, but that concern translating into concerns about a more aggressive tightening cycle from the Fed. I mean, do you have a sense, is this the start of the move, the change, the regime shift that people have been worried about for a long time, or is it too early to say? And do you specifically try and build in some kind of specific protection in the portfolios for rising rates and inflation, or is it just that you focus on being really diversified and having a robust portfolio?
Yeah, I mean, it's tough to really pinpoint the timing of these, quote, regime shifts. You can get some head fakes along the way. We've had a few in prior years. So I'm not as good as reading the macro tea leaves as anybody else is over the short term. But it does seem like you could make a case that, again, rates didn't have too much further to fall. So even if rates kind of stay really, really low, that still gives you a pretty poor outlook for bonds over the next 10 years, even if rates kind of stagnate, which I think is probably actually a worse outcome for savers and investors. What you hope for is a sort of steady increase in rates as opposed to something more violent that derails financial markets. But inflation, I think, really surprised a lot of people last year. I think it's been stickier than people initially expected, and just when you see those kind of headline numbers, that are the biggest we've seen in many decades, I think certainly more than I've seen in my lifetime. And so I think it can sound off some alarm bells to folks, but I think also at the same time, probably unlikely we see a repeat of the 1970s in terms of the kind of decade-long inflation, really, really high inflation type environment. I think some of that will subside, but I think there's also a strong case that inflation will be higher in the future to a degree than it has been in the prior 10 years. And I think, we've just had such an extended run for U.S. equities, for growth stocks in particular. And so I think, just understanding the history of market cycles, I think it wouldn't surprise me if we started to see the formation and the seeds, if you will, for perhaps a rotation outside of U.S. stocks into international stocks, from, growth into value. And so, the spreads on value stocks are still at pretty historic levels, despite, small cap value having a pretty great, 12 to 18 month period. So I think a lot of dynamics in place that might indicate that we're at, the earlier stage of some sort of change in overall market dynamics and where capital will flow and where ultimately, future returns might be. But again, we're not in the business of making that type of prediction and going all in or all out on one or more asset classes. We tend to not make those types of all in or all out decisions. It's more about having a long-term return forecast for each asset class we own and trying to tilt the portfolio a little bit in favor towards those areas that we're most optimistic about. But these tend to be more modest moves in nature. At the end of the day, we still want to retain the benefits of asset classes that we might deem to be expensive for purposes of diversification and just sort of a humility of we don't know what the future is going to hold, so we want to be prepared for a number of different possible outcomes.
Absolutely. And I guess your philosophy of being very much open to looking at different alternative investments is very much aligned with that kind of thinking of having robust portfolios and portfolios that can be performing in different market environments. So I guess that brings us to the area of alternative investments, and it's, as you say, it's quite an open term. It's what something isn't as much as what something is. When people think of alternatives, it can mean different things to different people, and depending on maybe your geographic location, you've got the whole gamut of different strategies and assets, from private equity and gold, hedge funds, property, which all of those might be debatable whether they are now traditional or alternative, right over to the other end of the spectrum of, collectibles, crypto, digital assets, NFTs, where you might have some debates as to whether they fall into the investment universe at all. So tell us, how do you think about the different categories of alternatives, and what's your framework for thinking about it?
Well, I mean, you definitely hit the nail on the head in the sense that you can ask 10 different people how to define alternatives, and you're probably going to get 10 different answers. Even when if you reference the same asset class, private equity would be a good example. Some folks might just view that as, hey, this is part of my long-term equity allocation. It just happens to be, quite illiquid, and I take on that illiquidity for the purpose of hopefully excess returns above and beyond a public market benchmark. So that's one area. Another would be, real estate. For publicly traded REITs, does that count as a real estate allocation, or is that part of your stock allocation because it's, one of the 11 sectors, in the stock market, and has the volatility of stock. So how do you place that in a portfolio? So there's a handful of other examples. Bitcoin is another good one where that might be more of a generational one where my grandpa might think it's all alternative. My nephew might view it more as a traditional asset, and because that's kind of what they grew up with. So ultimately, it's going to depend on your audience, and it's going to evolve over time too. Things that were once probably considered a bit alternative, things like emerging markets or high yield bonds, that have sort of crossed the chasm as they've matured as asset classes and are now pretty commonplace and kind of fixtures of more traditional asset allocations. And so when we think about like sort of a core ensemble of alternatives to include in a client portfolio, we're sort of aiming for that middle ground of risk and return between stocks and bonds typically, and focused more on things that are liquid or not liquid, or not fully illiquid, like things that kind of maybe fall in the middle from a liquidity standpoint. So that kind of leads us to a handful of categories. One would be just sort of broadly speaking, liquid alternative risk premia. So within that umbrella, you have things like trend following or managed futures, or maybe sort of event driven merger arbitrage type strategies. Things that have commonly been employed in the hedge fund world for decades, but are now more available in liquid formats. So that's one category. Another would be catastrophe reinsurance. Things like cat bonds are an interesting asset class, and that they're one of the really kind of truly uncorrelated things out there that are driven less by financial market variables and more so underlying catastrophic risk. And so that's an interesting asset class from a really pure diversification standpoint. Um, and then there's, you get into areas of real assets. So things out, you've got real estate is the obvious one, but also infrastructure and timberland and farmland and other kind of cash flowing tangible asset classes that are sort of essential, to the functioning of society and the economy, and that have some degree of, direct or indirect inflation sensitivity, that can be complementary to traditional asset classes. And then a growing world of kind of private debt and private credit type of asset classes that probably offer, in our opinion, you obviously are taking on a little bit of illiquidity risk relative to things like high yield bonds, but we think that's a better risk reward trade off today versus the kind of where yields are at in public non-investment grade fixed income. It just yields have compressed a high degree there, and the correlations spike pretty high in stressed markets and equities, and so they don't really provide as much diversification as perhaps something like middle market direct lending might. So that those are probably the main buckets of where we tend to focus our time and energy, and in our typical alternatives mix that we have for clients. Outside of that, you reference things like private equity. I think private equity could have a role for some folks, but I think for the average client we work with, it's probably not a must-have asset class. And then you've got the more novel end of the spectrum, things like you mentioned, like crypto or collectibles, NFTs. And I think there's a lot of interesting applications potentially for these asset classes. I think the challenge is the sense that they are so new. Maybe not collectibles. Collectibles have been around for a while. I think what's more new with collectibles is the fractional nature in which they're being made available today, as opposed to having to go, like if you're talking about like a baseball card that might be worth $1 million, you might not need $1 million to go buy the physical card itself and put it into storage. You can participate in that asset via fractionalization. So there's a handful of kind of tech focused alternative platforms out there that are trying to take some of these larger value collectible asset categories and kind of break them down into more reasonable bite sizes for individual investors. So that's an interesting area. The challenge with that or with crypto is, again, there's no cash flow component. There's limited performance history. So there's not a lot for allocators to go on in terms of really having a framework for expected risk and return. I mean, I've seen a few proposed methodologies for valuing Bitcoin and Ethereum and other digital assets, but I think they're all still pretty, novel and maybe not proven nearly as much as, the the centuries worth of data we have for global stocks. And so it's just I think those will continue to evolve, and I think it's not to write them off. I think there could be a role for crypto for a number of investors that might have the stomach for the magnitudes higher volatility that comes with it, than stocks. If you kind of size it appropriately and rebalance it, it can, at least in its history so far, is acted somewhat diversifying. That being said, we're going off a 13-year history for the asset class, so we're looking at a teenager effectively. And so like any teenager, you can expect erratic behavior from time to time. And so it's again, I think we'd be silly to just extrapolate the last 10 to 12 years of Bitcoin's results to the next 10 to 12 years. But that at the same time, that doesn't mean we need to dismiss it as a potential monetary store of value type of asset that could have a role that displaces gold to a degree. So I think we want to, like, the things that are a bit more novel, and you want to pay attention to them, but maybe not lean too heavily into them. There could be room for them in more of a speculative part of a portfolio, but in terms of kind of a core alternatives allocation, kind of look to the things that have cash flow associated with them, that have a intuitive kind of risk-based or behavioral-based reason for why that return premium should exist, and something that's had a little bit more staying power, that's a bit more proven. Tend to be the things that we want to include in that allocation.
You touched on some interesting alternatives that I'm sure people would be familiar with, and that I know you're an advocate for managed futures and trend following. Obviously, my own background is one, and you touched on insurance-linked securities and cat bonds, and then other liquid alternatives like event-driven or merger arb, etc. So they're all very different in terms of what they do as investment strategies, and they have different characteristics. How do you think about, is it including them in a portfolio? Is it about allocating to all of them, or does it depend on it client by client, or are there particular circumstances you would prefer one over another, or is it just that these are risk premia that you think are going to be there over time, so you want to have them all in a portfolio?
Yeah, I mean, I would say generally we want to have them all. Interestingly enough, the ones that have struggled the most recently tend to be the ones that clients don't want to own anymore, or they want to own less of. Whereas we probably would take the other end of that and say these are the ones that are probably the best to lean into a little bit now, and that are going to probably be the most diversifying when you want diversification the most. And so, I think, like, it's no surprise to you, I think managed futures has been a tough one to stick with the past decade, because it's been not a terrible decade, but not a great one, especially against, a backdrop of pretty good returns for 60/40 type portfolios. But at the same time, it's not just the sort of what of diversification we want to focus on. It's the kind of the why, the how, and the when as well. And one thing that we really like about managed futures is the when, in the sense that it has historically really shown up when you need it the most, when everything else and all the risk assets in the portfolio have corrected in concert with one another. And when you get these really, we haven't had one in a while, but these really sort of prolonged, nasty kind of bear markets, that tends to be when you see the best kind of performance from the asset class. So I think just educating clients and advisors on being patient, giving these strategies long enough, enough rope to kind of do their thing with, and don't put too much emphasis on 1 or 2 years of potentially subpar returns, because that might not be indicative of what to expect longer term. And so I think you probably want to own all of them, but probably maybe overemphasize the things that have a little bit more structural diversification or more dependency during kind of that risk off type environment. And so that would probably lean you more into things like trend following, or lean you more into things like insurance linked securities that are gonna, again, what's interesting there is the sensitivity to, like, rates going up or inflation being high. Like, it's pretty immune to those macro variables, because they don't really have an impact. Like, inflation could be up, down, or sideways, but that's not going to tell you anything about the return experience of reinsurance or cat bonds. And so I think that's a really, really compelling one. And so I think there's a case to be made for all of them. We like an ensemble approach, purely for the fact that there is no one perfect silver bullet alternative investment. If there was, we'd put all our capital into it. And so everything's got its flaws. Everything's got its environments where it's going to probably struggle. I think it's, where we come in our role in our team is to really get our clients and advisors educated on sort of what to like how do we simplify and translate these inherently more complex instruments and asset classes into something we can put on a one pager. Like what
Yeah.
is this? Why do I own it? When is it going to perform well? When might it perform poorly? What's the historical benefit? What should my expectations be? Where are you taking it from in the portfolio? So I'll kind of answer all those questions in a very simple, non-jargony type of way. I think is a really good way to get people comfortable with some of these things that they might not otherwise look to own.
You touched on a few of the questions that in my experience, we often got from advisors, particularly when you come to talk about alternatives and, things like where did it fit, the sizing, how much is enough, how much is too much, and do you fund them out of bonds or equities? And I guess in each case, it depends on the objective of the client and the specific strategy. What are your thoughts on those three issues? Sizing, funding from bonds or equities, and role in the portfolio.
Yeah, and I think too, like even liquidity is another feature where we have
Yes.
some clients that really place a high um, emphasis and kind of premium on having full daily liquidity in their portfolio. So that actually eliminates a couple of the alternative categories that we use, like private credit and real assets. We can't the way we access those strategies is not through daily liquid vehicles. And so if a client really wants to be fully liquid, then it just means that there's certain things that we're not going to be able to include in the portfolio. So we run a number of different sets of models that accommodate some of those preferences around liquidity and sizing of alternatives because it does introduce some questions there. To your point on where to source it from and how to size it, I would say probably not. We typically take from both stocks and bonds. It might depend on which alternative you're talking about, but if you look at the collective, it's sourced partially from both parts of the traditional portfolio. I would say in today's environment, it's more so coming from the bond sleeve. The majority is coming from where traditional fixed income otherwise might be if it was a kind of pure 60-40 type mix. The sizing, I think there's no perfect answer on what your alternatives mix should be. It's really somewhere in between enough to matter and not too much that it's going to cause you to, abandon the portfolio at the worst possible time. Because by the more alternatives and line items you add, the more different you're going to look than your peers, and the more line items you have, the more likely it is that in any given short-term period, there's going to be one thing that sticks out as uh, seeming like it's not holding up its end of the bargain and it's not adding to the portfolio. So there's always the risk of, oh, I'm going to get rid of this now because it's not working, quote unquote, not working. So I think we need to be mindful of that as allocators and advisors, that our clients aren't professional investors. They're looking to learn from us, but at the same time that we need to educate and provide, reasonable expectations. And so I think we need, we might have a higher target that we want to get to on alts, but we also need to be mindful of the behavioral ramifications of those choices. So I think every RIA firm is going to find the right sweet spot that works for them. But I think at the same time too, if you're going to do like 3% in alternatives in your balanced portfolio, you might as well do zero. It's not going to make a huge difference either way. So if you're only looking to sort of check a box, then I think you're almost doing yourself and your clients a disservice. It's either go zero or somewhere that's substantial enough where it's going to matter to the long term results of the portfolio.
And I'm conscious, obviously, you have to explain all of this to your client who may not be, I guess in most cases are not, investment professionals. But at the same time, there's a lot of tools and techniques open to you in terms of how to construct portfolios and portfolio optimization, etc. Are they things that you find helpful or not? Or, if you were to plug all your, inputs, all your different alternative investments alongside traditional investments with a set of, return expectations and volatilities and a covariance variance matrix into an optimizer and see what it comes out with. Would that be a portfolio that you could go to a client and say, I'm happy to stand over this portfolio or not?
I think it's helpful to go through that exercise periodically just to sort of see what the output is. But at the same time, we probably need to be thoughtful about imposing some degree of constraints in what we how much we're willing to go plus or minus off of strategic targets to some of these areas. Because again, as we mentioned earlier, that you're if the portfolio looks too quote unquote like weird, it just might be a really challenging thing to stick with. And so I think certainly we want to have the expected risk and return attributes of all the asset classes we allocate to. We want them to be, informative of how we make allocation decisions, but not to the degree that we're making humongous bets in the portfolio either. So I think there's a delicate balance to be struck between, you know, making over and underweight decisions based on some of those portfolio optimization exercises, but at the same time, still having a reasonable enough amount of tracking error that these are portfolios that most investors can kind of hold through thick and thin.
And to give us a sense, I mean, bringing it all together of the typical, obviously every client is different, every portfolio is different, but how much of it of an average portfolio, to the extent you can say average, would be in non-traditional or alternative assets and strategies in your experience?
I would say probably in like the sort of 15 to 20%
Okay.
region is tends to be the average for us.
Yeah, very good. Good stuff. Just shifting gears a little bit. Obviously, asset allocation and asset selection is pretty important, and most of the research would say asset allocation is the primary driver of portfolio performance over time. And in a lot of cases, you can get your exposures via beta products, via ETFs, etc. But in other instances, you have to actively select managers. And obviously, as an allocator, I had that challenge for the last number of years of grappling with choosing between managers. What do you think about the challenge of manager selection? Is that a different skill to asset allocation, or are there particular things you have to be cognizant of, in terms of behavioral biases as you approach the manager selection decision?
Yeah, I think manager selection is a hugely important activity that we perform with our research team and our investment committee. I think it'll vary by asset class. I think, as you mentioned, there's some asset classes where we just sort of want pure like beta exposure, so we're not necessarily hiring an active, stock picker, for example, for our U.S. large cap exposure. We just kind of want broad market exposure, and we want it very cheaply and tax efficiently as we possibly can. And so when you're looking at a handful of ETFs that by and large kind of do the same thing, there's not going to be as much variance there. And so it tends to make the decision-making process a bit easier because you kind of know what areas to focus on of cost or, turnover, what have you. The degree to which we, spend time on the manager selection side tends to be the asset classes where, we lean a little bit more into an active approach. Some of that by choice, in the sense of just like fixed income is a good example where plenty of parts of fixed income that might be worth taking a passive approach, but there's other parts, maybe it's credit focused sectors, maybe it's municipal bonds where there's been a little bit higher degree of persistence and active outperformance, based on those categories characteristics. And so we might prefer to have an active manager there, but with the active management comes a higher, degree of dispersion across, your top and worst performers. And so, that's where when you are sort of stepping out there and taking an active approach in a certain asset class, the allocation decision might be right, but if you get the manager selection, really, really wrong, then that can, almost eliminate any of the allocation benefits that you might have had. And so there's some asset classes that aren't really that indexable. You can pretty much index anything and every corner of the stock and bond market that you might possibly want to. There's not that luxury and a number of alternative categories. So by default, you almost have to select an active approach to access some of these areas. And so I think it's really figuring out, do you want something that's more systematic versus discretionary? And in some areas, does it make sense to employ multiple managers as opposed to one, where there is a high degree of dispersion in the category, and you want to make sure that you're not exposing yourself too much to any sort of idiosyncratic process risk. And managed futures is actually one area that we think actually does lend itself quite well to a multi-manager vehicle or approach, because you do get from CTA to CTA, you do see a high degree of variability, a lot of different, there's a simplicity to trend following in concept, but in practice and in implementation, every manager is going to have their own differences in implementation and the markets they trade in and their look back periods and turnover and all these sorts of things. And so that, that can lead to very, very different outcomes depending on what their focus might be, a short-term trend follower versus a more long-term focused one, a more kind of macro focused manager versus a pure trend follower. You get a lot of dispersion there. So I think, if ultimately at the end of the day, you just want that sort of managed futures beta, if you will, you might be better off in a multi-manager type approach for that access. So that's one example of a handful where it might make sense to either do the multi-manager yourself, where you're allocating to a handful of individual funds, or through one vehicle that you're essentially outsourcing that manager selection decision to a third party. And so either way can work. I think for the average advisor who let's say we'll continue to use managed futures as an example. If that's only 5% of someone's portfolio, you probably don't want 5 individual managed futures line items in someone's account. It's just going to create too much, implementation and operational headaches and behavioral risk. And so I think if you can get that same, outcome roughly in one fund, you probably want to lean towards that type of approach, in our opinion. So
interesting. And obviously, you've got the manager selection decision. An equally difficult one is, the scenario after you've had a manager in place for a number of years and performance hasn't been quite what your expectations were. Do you have, processes in place, or how do you approach that to decide, okay, this particular manager or strategy hasn't performed in line with expectations and we need to review and deselect that manager? Is that something that goes through kind of a formal process, very much quantitative kind of process, or is it more of a subjective assessment?
It's both. We have our investment committee has a quarterly review process we do for all the managers and funds that we use in our portfolios, to really try to measure quantitatively first and foremost, like, is anything sticking out? And we kind of use a traffic lights, system of green, yellow, red to identify like any yellow and reds that might need attention from us. But it's those quantitative outputs aren't they're not the hire fire decision. It's more like, hey, we might need to let's pay some attention to this and figure out what's driving this fund or this manager showing up on the list. But then ultimately, it's a little bit more of a qualitative assessment, some conversations with the manager. But we want to be very patient. Like if we're going through all the upfront diligence to get comfortable with someone's approach and process, and we know that there's going to be variability in returns. That's the nature of any active approach. So you have to understand going in, there's going to be a short-term period where you're going to look like you made a poor decision. That we can't confuse outcome with process, and so I think it's just sort of re-underwriting things, being patient. We tend to be slow to make decisions because we want to kind of measure twice and cut once, and so and we're not interested in turning our portfolio over frequently in a given year. So I think we give managers enough leash to let them do their thing. But if we feel something material has changed from a people or process standpoint, or maybe our thesis has changed on an asset class, then yeah, I mean we always retain the ability to make changes. But I think there's been too many studies shown that institutions and other allocators are not great at timing hiring and firing decisions. That they tend to be almost counterproductive in the sense that the opposite approach probably would have worked better. You typically don't see things added to a portfolio that are coming off of a period of abysmal performance, and similarly speaking, the managers that get fired, it tends to be off periods of weakness. But then if you measure the performance after you fire them, like you tend to see some mean reversion. So if something doesn't feel like it's broken, then there's probably not a high degree of urgency to make a change.
Yeah, no, absolutely. I think that's really the challenge is separating the randomness in the return series, which is something that people struggle with. And you touch on outcome versus process there, and if the process is not broken, you have to satisfy yourself that returns or something is outside of statistical expectations.
Well, and I think another good example there, it's not even just specific to like your traditional active approaches. Like even if you look into things like index funds or kind of factor-based like equity strategies, a good example would be like the last decade for up until the last year and a half. But like for value had kind of its worst stretch on record. But if you look at category level performance, the things that sort of look the best in the category are going to be your index funds or your factor strategies that really aren't getting a high degree of like that factor beta. And maybe they're a little bit more vanilla in their construction, more market cap weighted, and more, they might have value in the name, but they're not giving you a high degree of exposure to the value factor. So, of course, when the value factor is extremely out of favor, those things are going to look better. That being said, the things that might look worse in that category during a period of really historically bad value performance are probably the things that are, giving you a more pure focused, like deep value type exposure. So they might look worse within their category over that stretch, but if you're confident that value will reemerge, then you probably want to maintain that holding, because it's going to give you the most bang for your buck if and when things ultimately go the other direction. And so I think that's another. It's not just a simple, it's a little bit different to kind of analyze and diligence factor funds and index funds than it is your active manager, but I think there's also some parallels as well.
Yeah, it's interesting. I mean, you say there, if you are confident, say that the value factor is going to return, and it's that point that's the really challenging bit, that level of confidence, because with all of these things, whether it's trend following, experiencing a period of underperformance, or the value factor experience a period of underperformance, there will always be a narrative around why that's happening, and why maybe something in the world has changed to explain that, I'm not an expert on growth versus value, but there has been a narrative put forward. The world has changed. You have to be more growth focused, and equally there was the same narrative put forward as to why trend following had stopped working. And I think this is a good segue into another section in your book where you're talking about what it takes to kind of be a good allocator. And you mentioned a perspective from Michael Mauboussin, who had, that there was four edges in investing, analytical, informational, technical, and behavioral. And your point was that, well, the analytical, informational, and technical are gradually being eroding over time as people, get more sophisticated in their analysis, and, as data becomes more readily available. But it's the behavioral side where people can, and investors and allocators can differentiate themselves. So how do you cultivate that behavioral edge as an allocator?
It's not easy. I don't think anyone's, we're even professional investors and allocators are still human beings. And so even though they might be more aware of, some of the common behavioral biases that affect investors, it doesn't mean we're any, better at avoiding them. We might think that we are, but at the end of the day, I think we're all susceptible to them. I think, your temperament and behavior as an allocator and an investor is going to be a big determinant of your long-term success. And so I think, according to Michael Maubussin's framework there, I think that is the most important sort of edge that there can be, is behavioral. And I think it's the one that, as long as human nature is what it is, those that have the behavioral, wherewithal are going to be the ones that do the best. I think if you sort of take that framework and think about, well, what would an allocator look like, that has the highest odds of building portfolios designed for long-term outcomes and not just following the crowd. I think I came up with an acronym for it in the book, and I call it SHARP. Kind of fits with edge, a sharp edge. But to me, it has to be sensible. You need to be humble. You need to be autonomous in your thinking. You need to be resolute, and you need to be persevering. And so to me, those are the kind of 5 defining characteristics of if you want to focus your attention on, how to improve as an allocator. It's really trying to make sure that every way that you approach the portfolio design and construction process is trying to, just make sure you're being mindful of those 5 attributes in the decision making that you employ.
Yeah, it's interesting. I mean, you have this, really comprehensive book about investing and alternative investments, and you get to the final chapter, and what really came out to me was the importance of courage. So it's this behavioral idea that, if you want to be very successful, and if you want to do a good job as an allocator, one, you can't just follow the crowd. As you say, better to very often the view is better to fail conventionally than succeed unconventionally. But that will obviously lead to pretty average results. So to deliver for clients, it's about, as you say, thinking more autonomously and having the courage of your convictions. I guess that's great in theory. It can presumably sometimes lead to some difficult conversations with clients.
Yeah, and I think if the hope of a reader is to open up the book and that there's some magical answer in there about here, oh, the allocator's edge is this asset class that's gonna be your silver bullet and cure everything that ails your portfolio. There's unfortunately you're going to be disappointed, but the real edge is going to be ultimately it's not one asset class, it's not a mythical perfect portfolio that we know doesn't exist. We think we can improve upon the traditional portfolios, but ultimately at the end of the day, what's going to get us to those successful outcomes is that conviction, is that courage to think and act differently than our peers.
And I guess if you think about the last number of years we've had in markets, and as you say, you touched on some of the themes that are starting to show signs that might be about to change. International stocks versus U.S. stocks, value versus growth. Some of the alternatives starting to come back. If we were to go back to say, December 2019, or maybe even a number of months ago, and the performance of the S&P 500 would have probably done much better, maybe even in risk-adjusted terms, than your very diversified portfolio, incorporating alternatives, incorporating these tilts. And that's where I guess you can convince people at an intellectual level, okay, I can see the case for diversification. But when a concentrated portfolio of FANG stocks is massively outperforming, then I guess you have to go back to first principles with clients and explain everything bit by bit as to why they are invested in all of these different strategies. And for advisors out there and people advising clients on being diversified, any helpful tips about how to manage those conversations?
It's not easy. I mean, my friend Brian Portnoy is fond of saying diversification means always having to say you're sorry. And it really does, because by the very act of diversifying, you're eliminating the potential of being overexposed to the worst performing asset class, but you're also limiting your ability to be exposed to the best performing asset class. The challenge though is we can't know without the benefit of hindsight what the best performing asset class is going to be over the next 1 year, 3 year, 5 years, 10 years. I think as human beings, we have very short memories, and we had an incredible decade for U.S. large cap stocks. And in hindsight, yes, of course, it would have made more sense to own more of them. It would 100% in hindsight would have been probably the right move, but we have no way of knowing that without the benefit of hindsight. And so I think you just need to remind people that that's not always been the case. We only have to look a decade prior to the 2000s, where you had a negative 10-year period for the S&P 500. So it is not I think the challenge is that when the best performing thing is the index that people get reminded of or kind of thrown in their face every single day, it's the first thing you see on CNBC or in the financial media. Like, everyone knows what the S&P 500 is. So I think that's made it harder. Had it been like emerging market stocks that had had the same stretch of performance over the past 12 years, I don't think there would be any clients that are saying, oh, I want to put 100% of my portfolio in emerging markets. They might want to say, hey, should I be owning more of this? But it's a little bit of a different dynamic, and it just so happens that the thing that's been the best place to be is what people are most familiar with and kind of comfortable with. So I think that's what has made this kind of last sort of market environment so challenging for diversified allocators. But I think just kind of bring people back to other historical periods where that it wasn't such a pretty picture. And I think it's helpful to remind people, because we get so caught up in recency bias that we extrapolate it to the future. And so we need to just examine other time periods where there has been a benefit to being diversified. And at the end of the day, you still, many of our clients, like their biggest holding is still U.S. stocks. It has been, just because it's a huge, it's the biggest stock market in the world, and a lot of our clients are tilted towards stocks. So it's not like you've missed out on the returns. It's just that we'd be doing you a disservice if we were making such concentrated bets in our portfolio that we were overexposing you to the potential downside, because it can and will manifest at some point and that's not our job to to make those calls for you. Our job's to work as your fiduciary and try to do everything we can to improve the odds of your long-term success.
I think you said you started your career in 2008 in your dad's firm. I mean, was that, that experience of being in the markets and that being your first year in the markets, do you think that has had a big impact on your mindset in terms of the need for diversification? And if somebody had started, maybe a little later, that they mightn't have had that mindset?
Probably, yeah. I mean, I was still very, green and kind of learning the ropes of the business. So, it was all, pretty scary at the time because I didn't really know what was happening. Like, nobody really knew, but like for not really having that sort of financial, acumen that I have today, it was a little, more just like kind of eye opening, and it was certainly, learning. It was a great learning experience, if nothing else. Fortunately, I didn't have a lot of actual dollars at risk at that point, just because I didn't have like two nickels to rub together at that point. So, despite my 401k balance being down, by half, from a dollar standpoint, it wasn't as painful. But I think that has been informative to my thinking about diversification, and that I saw the impact that it had on the behavior and kind of worst fears of our clients. And as much as our advisory team did a fantastic job throughout that crisis period to keep people in their seats and keep them focused on the long term, and you know get them to the other side of it, knowing that this too shall pass. There's always going to be some outliers, and you did see some people make some really sort of irreversible decisions. Those folks that kind of tap out at the absolute worst time, like right near the bottom, and then they're going to be scared from getting back in for years. And so when those are sort of irreversible financial decisions, and that's what really struck me as why there is such a need for diversification and for balance in a portfolio, because you can have these really extreme environments that bring out our worst tendencies and decision making abilities, and that the last thing we want to do is see all someone's hard work throughout their life and their career that's meant to support their retirement and all their other financial goals, if they're going to fall short of that because they were too overexposed to one asset class and couldn't hang on to the portfolio. Then I think it just really kind of reminded me that risk management is such a key input to what we should be doing for clients. You still want to have that long-term appreciation and growth of a portfolio, but you need to manage risk as well.
Good stuff. Before we wrap up, it'd be great to get some perspective for you for would-be asset allocators, for people starting off, or for people who want to get better at asset allocation and alternatives. Any advice you have to offer in terms of things to read, things to do, any books or people to follow that you think would be very helpful for somebody looking to develop their expertise in asset allocation?
Yeah, I mean, I would say the book that's been most useful to me and that I go back to from time and time again has it's a pretty thick and dense book, but it really was eye opening for me in many ways. It's a book called Expected Returns by a gentleman named Antti Ilmanen, who's now at AQR. To me, that's been the most influential book in terms of my thinking about portfolio construction and asset allocation, and really was kind of the aha moment for me in a lot of ways when it comes to diversifying outside of traditional portfolios. Outside of that, I would not to give my book a shameless plug, but I will make a note that because of the length of the book, there's only so deep I can go into some of these areas. But I understood that a lot of readers might want to go deeper themselves and kind of go down the rabbit hole on one or more of the different topics covered in the book. So I included an appendix at the end of the book that I really wanted to be kind of a helpful guide to, okay, if you want to learn more about private equity or insurance-linked securities or real estate, every topic covered in the book has a section in the appendix where I list any books, white papers, articles, or podcast episodes that I've found to be helpful in learning more about these categories. So it's a pretty long. It's like a 3-4 page appendix, but there's a lot of really good pieces of content in there that can kind of help you go even deeper than I was able to in the book.
Great. Well, it's been a pleasure having you on, Phil. It's been a really informative and enlightening conversation. I hope it's been fun for you too.
Always fun to chat with you, Alan.
Great. Well, listen, good talk to you, and best of luck for the rest of the month and year. So with that, I'll hand it back to Niels.
Thanks so much, Alan and Phil, for a great conversation. I really enjoyed learning about Phil's take on what it means to be a good allocator and his SHARP acronym and what that stands for. It was also great to hear about the courage it takes to be a diversified investor when the investment that people follow the most is going through a rampant bull market like we've seen in the US stocks. Make sure you go and follow Phil's and Alan's work because, as you can tell from today's conversation, there are many exciting facets to building a well-diversified portfolio, and we really look forward to exploring many more of them as our series continues. From Alan and me, thanks so much for listening, and we look forward to being back with you on the next episode. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.